Louise, it's a pleasure to see you here. I'm very happy to see you here at Money 2020. How is the conference for you?
Well, it's been fantastically busy. I was chairing a couple of sessions this morning. I'm now doing a couple of podcasts. I've had about 30 meetings. It's busy.
Uh, it's a lot of sessions, a lot of panels, a lot of people. You wrote that every country building an open finance framework makes one of two mistakes.
Over-engineering, under-engineering, that's what they do.
Tell us more about this.
Yeah, so let me explain what open banking, open finance is for a start. It's when you use the data you create through your financial behavior to access products and services that make your life better or make your business work better. Open banking is for banks, open finance just extends it to pensions, insurance, mortgages, and so on. The first mistake is called over-engineering, and that's what I call building a Rolex when you really need a Swatch, right? You spend 5 years perfecting the mechanism, and by the time you've done it, the world has absolutely changed. So you can see it in the markets that have produced these really detailed technical specifications, and nobody's really implemented it at scale because the commercial model just didn't work. Australia is a great example of that. The second mistake is under-engineering. It's called what I call the empty pipe. What happens there is you've built the infrastructure, the rails, the APIs, the consent mechanisms, and then you stand back and wait for the market to fill up the pipe. And the market's going, well, hang on, I've got risks and my risks aren't managed. Where's the liability framework? Who's accountable when something goes wrong? And when nobody gets the answers to those questions, the adoption falters. And in the UK, I say this with enormous affection because I've worked in the UK for 15 years doing this, we're making that second mistake now. We've genuinely got world-class infrastructure, that's great, but we've built the pipe without the safety net. So what we're doing at Invela is making sure that we're putting that safety mechanism in place. The EU is, it's making the same mistake, but it's the EU, right? It's doing it in slow motion, but it's the same mistake. So we believe, yes, regulators have a role, of course, legislators have a role, but the markets also have a role. We need to step up. Invela is stepping up. It's about risk management in open finance.
So your takeaway from a recent Smart Data Council session was that the most powerful thing Smart Data can do for consumer adoption is make the ecosystem genuinely safe. At the same time, not just understandable to the customer, to make it more safely, and what's the difference between taking the risks, managing it, or disclosing it?
I think the industry has spent a decade solving the wrong problem. That's the first thing to say. We've been absolutely obsessed with transparency tech, right? Consent journeys, data dashboards, disclosure notices. We've got very good at telling consumers and businesses what's happening to their data, and that transparency matters. But there's a crucial gap between a consumer and a business knowing that their data is being shared and genuinely being protected when something goes wrong. So imagine an electricity grid. You don't need to understand how that grid works in order to plug in your kettle, right? You don't need a disclosure notice. You don't need to tick a consent box every time you make a cup of tea. You trust it because the infrastructure below it is actually safe, right? Because there's standards, there's monitoring, there's accountability built into the system at a level you as a consumer wanting that cup of tea, you never see that. And that safety is really structural. It doesn't need to be disclosed to me, the consumer who wants a cup of tea. It's just there, it's safe. Open finance is still at the stage where we're handing the consumer a disclosure notice and calling it protection. It's not. It's handing them a disclosure notice. So what we actually need to do is get to the stage where the infrastructure below it is so safe, the risks are all managed, that the disclosure notice becomes completely irrelevant.
You watch a lot of firms trying to implement return on compliance into competitive advantage.
Yep.
Sometimes some of them made it wrong, sometimes some of them made it good. But at the end, what does the open finance landscape look like in 3 years for the firms that read the regulation correctly versus the ones that didn't?
There's a herd mentality, right? Most of the firms that get it wrong the same way. They treat compliance as a cost center, something that you minimize, then you try and outsource it, you give it to the legal team, you do it once at onboarding, you file it away. And then they wonder why their bank partners are slow to connect with them, why deals take 18 months to close, why the people from risk and information security keep turning up and asking really uncomfortable questions in commercial conversations. The firms that get it right treat compliance as market infrastructure. They don't do the minimum. They build a risk score that's genuinely defensible, continuously maintained, visible to their counterparties, and that means it's highly commercial. Bank relationships open up faster, procurement cycles get faster, the conversations that used to get stuck at the onboarding questionnaire level actually move faster as well. So think about that 3-year time frame, and now imagine 2 fintechs. They launch at the same time, they've got about the same product, they're targeting the same market. One of them treats risk management as a tax on innovation, something they've got to minimize, and the other builds it into the foundations of what it is that they do. 3 years from now, that first firm is still spending 6 months closing every bank partnership. They're still answering the same onboarding questionnaire every single time. And the second one has got a dynamic risk indicator score that they can just share. They're part of a trusted network, the Invela network. Banks just connect with them because it's the safe and obvious thing to do. They don't have to fill in questionnaires, they just share their risk score. So I think the market's going to bifurcate. It's going to go to those people who treat all of this as just an inconvenience and those people who treat it as an accelerator.
Thank you very much for coming. Thank you very much for insights.
Thank you.
And I wish you to have a very productive Money 2020 conference. It was
I
a
can
pleasure.
promise you I will. Thank you,
Thank
Dimitri.
you very much.
Thank you.